Hey, welcome back to our 50-day finance journey. It is day 5, and today we are officially rolling up our sleeves and getting to work. We've talked about what to invest in, right? But now we're going to tackle the big one. How do you actually do it? Today, we're building your investor's toolkit. Let's get into it.
So here's the plan. First, we'll cover the nuts and bolts of how your money actually gets invested. Then, we're going to look at how you can own a piece of, well, everything, from the entire stock market to giant shopping malls. After that, we'll forge a shield to protect your portfolio, and we'll finish up by building a much smarter emergency fund. You're going to walk away with 4 powerful new tools today.
All right, first up, in our last explainer, we talked all about picking the right mutual fund. So what's next? The most important step, really, actually getting your money in there. So you've done the hard work. You found a fund you're actually excited about. Awesome! But then you hit a wall. How does the money go from your paycheck to your portfolio? What's the best way to do it? Let's break it down. Okay, so you really have 2 main choices here, SIP or lump sum. You can think of lump sum like paying for a full year's gym membership upfront. Boom, all at once. A SIP, on the other hand, is way more like a Netflix subscription. It's a small, fixed amount that you invest automatically every single month. It's all about that consistency. Now, this is the real magic of a SIP. It's a superpower called rupee cost averaging. Just look at this. When the market dips and prices are low, your monthly investment buys more units of your fund. It's like a sale. And when the market is high, you automatically buy fewer units. Over time, this all averages out your purchase price and completely removes the stress of trying to time the market. It's smart, it's automated, and frankly, it's a game changer. Okay, tool number 2. What if you want to go bigger? What if you want to own not just a handful of stocks, but like the entire market? Or what if you want to invest in massive real estate projects, but you've only got a little bit of cash to start with? Well, say hello to the ETF, or exchange-traded fund. The best way to think of it is as a single shopping basket that holds, say, the top 50 companies in the entire country. You buy just 1 share of that ETF, and you instantly own a small piece of all 50 of those companies. And the best part? It trades on the stock market just like a single stock, so it's super easy to buy and sell. So why should you care? Here's the no-bluff breakdown. They are incredibly low cost, they give you instant, massive diversification, and they're as simple to trade as clicking a button. It is, without a doubt, the easiest way to own the whole market. Now, what about real estate? You think you need crores of rupees to get in on that action, right? Think again. Meet the REIT, or Real Estate Investment Trust. This lets you own a tiny slice of huge income-generating properties. Think office buildings, warehouses, shopping malls. You basically become a landlord without ever getting a call about a leaky toilet. And here is why REITs are just so cool. You can get into the real estate game with very little money. You have pros managing the whole thing for you. And you can get a cut of the rent they collect as regular income. I mean, come on, that's a win-win-win. Okay, so we've talked about growing your money. Now let's talk about protecting it. Because look, markets go up, but they also come down. A smart investor is ready for anything. It's time to add a shield to your toolkit. This quote says it all, really. When things get chaotic and markets are shaky, you need an anchor. You need something in your portfolio that's going to hold its ground when everything else feels like it's in a freefall. And for centuries, that anchor has been precious metals. I want you to think of gold and silver not as some way to get rich quick, but as your portfolio's shock absorbers. They're there to smooth out the ride when the road gets bumpy. So what is their actual job? 2 things. First, they protect your money from inflation. When prices for everything else go up, gold tends to hold its value. Second, when the stock market takes a nosedive, investors often flock to gold and silver, which helps stabilize your portfolio. They are your financial defense system. All right, let's talk about the ultimate defense system, your emergency fund. Now, we all know we need one, but where you keep that money, that's a whole other story. And I'm telling you, your standard savings account is probably the worst place for it. Take a look at this number. Right now, your savings account is probably giving you what? A measly 3, maybe 4%? What if I told you your emergency fund could be earning double that, or even more, without taking on a bunch of crazy risk? Well, that's exactly where debt mutual funds come in. This chart lays it all out, plain and simple. You can see debt mutual funds have the potential for way higher returns. Now, you might be thinking, is it safe? And yes, they're very low risk because they invest in super safe things like government bonds and liquidity. Getting your money out is almost as quick as from a savings account. For that 4 to 6 month emergency cushion, it's honestly a no-brainer.
Whew, we have covered a ton of ground today. We've added some seriously powerful tools to our belt. Let's do a quick recap of everything we've just learned. So here it is, your brand new Day 5 toolkit. 1. Use SIPs for consistent, automated, stress-free investing. 2. Diversify like a pro with ETFs and REITs to own a piece of everything. 3. Stabilize your portfolio with the shock absorbers, gold and silver. And 4. Put your emergency fund to work with high-yield, low-risk debt funds.
And there you have it, 4 new essential tools in your investor's toolkit. You now have the strategies to not just dream about your financial future, but to actually pick up the tools and start building it. So the only real question left is, what are you going to build first? I'll see you tomorrow for Day 6.